Hey, good morning, everybody. Welcome to this week's Coffee with Kirk. Appreciate you taking some time out of your week. Today, just going to hit on a couple topics dealing with countries on the other side of the Pacific. So, I try. It's always hard to put these things together, and I try to put some interesting topics together for you. And as I also said, it's kind of a learning experience for me to learn right along with you. So it's sometimes just stuff that I'm interested in too, and then try to present that to you. So I'm going to talk a little bit about Japan and talk a little bit about China today. Just a couple topics. Hopefully you'll enjoy it. But I think both of them are going to be playing a bigger and bigger role here for some, probably in both cases, kind of not nefarious, but it may not be exactly what we want. But let me jump in. We'll do some slides like we usually do. Okay, so the first thing I'm going to talk about is just Japan. And I'm going to start off with a little quote from Ernest Hemingway back in his book, The Sun Also Rises. It was after World War I, and there was just kind of a feeling of, a lot of people like, what's the point? Just enjoy yourself today, because, who knows what tomorrow brings. And conversation between a couple of the characters. And I use this line a lot. How did you go bankrupt? Two ways: gradually and then suddenly. And, I kind of have a feeling that could be what's happening here with Japan. And, we might start to see some real negative effects here due to, probably the third or fourth largest economy in the world starting to finally have some serious issues. Now, I'm sure most of you listening to this today were, around and probably near or in adulthood in the 80s. And Japan was basically seen as the economic juggernaut. They were, everybody's talking about them displacing us as the world's largest economy. Got to the point where their asset prices were so expensive. At one point, the Imperial Gardens, they said, was worth more than the entire state of California. And just Tokyo real estate, the price for Tokyo real estate was more than all of the United States. So, things clearly were bubble-licious back then. It just got really nuts. So eventually, they peaked out in 1989. And then from 1990, for the next, really up until recently, they have been in an absolute kind of funk. And the thing what scared the Japanese government so much was when you have such a bubble like that and then it deflates, and a lot of it's backed by debt. When you have real estate in Tokyo worth more than all of the United States, well, it's not all like cash investment. This is a lot of debt. So they were absolutely, completely afraid that they would see sort of a debt deflation similar to what the world saw in the late 1920s, early 1930s, when, debt was just going away and you had a massive deflation. So they were so afraid of that. And to give you kind of an aspect here. So this first chart that you're looking at, Japanese household debt to GDP, was this is individual households, as you can tell, how much debt they had relative to the size of the economy. And you can start to see really started to escalate there about 1980 up through 1990. But then they had a period where the individual households really kind of, I mean, they weren't necessarily deleveraging too much, but they certainly weren't continuing to add on any more debt. And it did start to go down after the year 2000. So they did have some deleveraging at the household level. And then I looked for a chart. I couldn't see a chart for just the business debt. So this is a chart that it only goes back to 1996, but it's both Japanese business and consumer debt put together. So it's basically the slide we just looked at plus the businesses of Japan. I wish I could show it from 1989 because you can clearly see from 96 all the way until probably 08 that it was a downward trajectory. And it was even more massive of a downward trend from 1990 to 96. So what you did have, while this graph before shows we didn't see a massive consolidation at the household level, we didn't see any kind of growth either. But at the business side, we did see some serious deflation, some serious debt deflation on the business side. So as far as businesses, they saw a massive amount of deflation. So the Japanese government was so afraid of what was going to happen. So what they did to avoid any kind of debt spiral or debt deflation or just deflation in the country overall was the Japanese government then took on a massive amounts of debt to prevent any kind of serious deflation like they saw in the 1930s. You could see from this chart in 1989, basically at the peak of the Japanese bubble, they were probably 60% debt to GDP. So meaning, the debt level that they had was only 60% the size of their GDP, which is very, very healthy. But then you can see from that point on, what they did is the Japanese government levered up, basically expanding to the point where they have about, I think it's 272% debt to GDP. So that means they have $2.72 of government debt for every dollar of gross domestic product. Now, Japan did avoid the massive 1930s deflation that they were trying to avoid, but they never really saw any kind of sizable growth. They didn't have any inflation at all to speak of. So a lot of people say, well, that's a great thing to have happen in that they were able to avoid any kind of 1930s issues. And, they didn't have any kind of massive inflation, but they just never got any growth on their economy. They just never, they've been in economic funk since 1989, honestly. They've had, kind of falling prices and economic stagnation for that whole period. And so you can kind of see over that time period, the Japanese central bank, their balance sheet has just gone absolutely, skyrocketing from that 1989 bubble. And, it started off slow. You could see they were certainly adding some debt on, but then, basically around 2012, it just went absolutely nuts. So what you had up until 2012 was the Japanese government was issuing, again, a lot of debt. So again, this is the Japanese government debt. So they were just adding more and more debt on. But what was working out well is they had buyers for their debt. They had plenty of buyers. So they were able to, either with internal consumers, their citizens or foreign buyers, they were able to fund the debt that they were producing. Because, up until 2012, all right, yeah, they did get a little bit high. They went over 100% debt to GDP and then over 150, but they were still able to fund it. But then what was starting to happen was interest rates were starting to go up because, like anything, if you issue more and more of your debt at some point, investors are going to demand a higher interest rate in order to compensate them for the extra risk. I mean, the more and more debt you put out there, the higher the rate that they're going to charge. I mean, you think about it on a personal level. If you don't have a lot of debt, you might have a very good credit score, and banks will lend to you at very reasonable rates. But if you have a ton of debt and you go looking for more debt, banks are going to start to request higher and higher interest rates to make up for their risk. So that's exactly what they were seeing. And then, it started to break down around 2012, where they just weren't finding enough buyers for their debt, or they weren't finding buyers at interest rates that they really wanted to pay. Because just like we're in a situation now, when you have way too much debt, the amount of interest expense that the government is spending on that debt goes up and up and up. So what the Japanese central bank did at this point is, in 2012, they started to really start to buy a lot of government bonds. So they were buying a lot of the Japanese government bonds. And in fact, what they did is they did something called yield curve control. So they said that we are not going to pay anything over 0.9%. So the way it would work is the Japanese government would go out to the market and issue bonds. But if they started to find that the bidders on these bonds, that the people who at these auctions were requesting a higher yield than that 0.9, well, then the Japanese central bank would just step in and print yen. They'd print their currency and buy the bonds. So you can see, essentially from 2012 on, the Japanese central bank just went nuts, because they set this rate and nobody would buy Japanese bonds at less than 1%. It just wasn't going to happen. So they basically became the only buyer. The central bank became the only buyer of Japanese bonds for the most part. So this is just a chart, going back to 2019. So I couldn't find this exactly all the way to 2012, but you can kind of see the interest rate that was being paid on the 10-year Japanese government bond. It never broke 1%. And in fact, in some periods, when COVID hit and actually before COVID, they had negative yields. So they had a point where an investor wouldn't even make money on it. But so this was just something that was clearly the central bank printing their money to buy the bonds. Well, now they're kind of in an interesting situation. For all these decades, they've been wanting to create inflation. The government stepped in to stop any kind of debt deflation or price deflation. And it sort of caused an economic funk, where it wasn't horrible in Japan, but it wasn't really growing. And the government has been trying to get inflation for, 30 years. And then all of a sudden we have COVID, and you saw supply chains get hurt. So that's naturally going to be inflationary. And then, of course, with what happened in the Ukraine and Russia, we started to see energy prices go up. So now all of a sudden, Japan's kind of getting their wish. They're getting some inflation. But the problem is, because the central bank has been basically printing money to buy these Japanese government bonds, they've just been creating yen out of nothing. Well, now they have a problem, because inflation is actually going to start to hurt. Because inflation is going to hit both the currency and the bond yields. So, they have printed so much yen over the past, since 2012, that now that they are having inflation, all this currency out there is going to be a problem. And you can see this chart. This is the US dollar divided by the Japanese yen. And this is just going back 5 years. But you can start to see that the dollar is getting much stronger relative to the Japanese yen. So now you have a situation where they've been wanting inflation forever. And they started to get it after COVID. And the fact that they had printed so much Japanese yen over the decades, well, now the Japanese yen is losing value, which is even more inflationary. So now Japan could actually go from 30 years of a sort of a deflation or disinflation environment to one of inflation. And the problem is they can't continue to let their bonds stay at sub 1% when you have 270% debt to GDP. You can't continue to print those yen to buy those bonds and pay that government interest, because it's only going to now make the inflation problem that much worse. It's going to accelerate inflation. So they could get to a point where they're still sort of in an economic funk. They've been pulling out, but their inflation could go up much faster than their economic growth. So now they have a true inflation problem. So at that point, the central bank has really no good alternatives. We talked about this before. You can either save the bond market or you can save the currency, but you can't do both. If they decide that they're going to continue to save the bond market and they're not going to let Japanese bonds go up to where they might normally trade, say 4, 5, 6% in interest, they're going to keep it at 1. So they're going to continue to print Japanese yen to buy these bonds. If they protect that bond market and try to keep the interest expense of the Japanese government to a more reasonable level, well, they're printing more and more yen, and that yen's going to lose value much, much faster. So now they've created a real inflation problem for their constituents. Now, if they try to protect the yen, the only way to do that is to have less yen relative to dollars. So, either the Japanese central bank would have to raise interest rates to pull yen out of the markets. But here again, now that's basically saying we're going to let the bond market suffer. If you let interest rates go up, you do pull Japanese yen out of the economy. So that does protect the Japanese yen, but it's going to kill their bond market. The other option that they've got is they have a massive ownership of U.S. treasuries. And in fact, they are the largest foreign holder of U.S. treasuries. And the reason they are is they are an export nation. They export more than they import. So they have a account surplus, and they take that surplus, and what they've been doing for decades is buying treasuries. That's where they put their money. Well, if we go back to that relationship between U.S. dollar, the only way to strengthen the yen is to have less yen relative to dollars. So you need either the supply of dollars to go up and keep the yen consistent, or you need to bring the supply of yen down under a consistent dollar. So it's that supply demand. Now, Japan can sell their treasuries. They could just sell the U.S. treasuries, and that forces dollars to come into the system. So now all of a sudden, when you sell those treasuries, in essence, the U.S. government has to release the dollars. Japan shows up, hands them the bond, and then they have to hand the dollars to the Japanese government. So that is going to cause us a problem because at that point, we are now in that same sort of situation that the Japanese government's in. If one of our biggest holders of treasuries starts to sell to protect their currency, then we're going to be in a situation where our bond yields are going to have pressure to go up. because now all of a sudden you have more sellers than buyers. And the only way you can rectify that situation is by offering higher yields on your debt to attract buyers. So now our economy is going to get hit as Japan is selling treasuries, because our yields are going to be going up. Or it's going to force our central bank at that point to do what the Japanese central bank has done and start to directly print money and buy treasuries and set a yield curve control and say, we're not paying anything over 4% or something like that. And then we end up going down the path of Japan. So Japan is finally getting what they want, and they might find it's not actually what they want. They've been trying for 30 years for inflation, and now they're getting it, and they're getting it good and hard. That's what they're starting to see, and it's probably only going to get worse. We've talked about this, why I think we're in an inflationary environment here going forward, especially regarding energy. But their problems might become our problems awfully quick. And it's got another component to it as well that could really create some serious dislocations. That there's, for basically the past 20, 25 years, there's been what's called a yen carry trade. So what a lot of financial institutions, hedge funds, private equity, pension funds, everybody has kind of done this, is what they do is because the interest rate on Japanese government bonds was so low, you would borrow in Japanese yen and then take that money and invest it in US dollar-based assets. So they would leverage up with Japanese yen and pay that lower interest rate, and then come over here and you could invest in treasuries. Right now you get treasury, short-term treasuries at 5%. But your interest cost in Japan is, really maybe 2% or below. So you're getting that arbitrage between 2 and 5%. Well, a lot of financial institutions, like I said, have levered up. They have gone above 100% of their capital to do this because it's been such an easy trade. It's been an easy thing to do for the past 20 years because the yen, for the most part, was pretty consistently pegged to the dollar. Wasn't a whole lot of movement in the currencies. So you would consistently get that difference between treasuries and Japanese government bonds. Easy way to pick up some money. But now if you have a situation where the yen has problems, or if Japanese bond yields go up, either way, it's going to cause some dislocations. And if you find out that there's been some parties out there who have taken on too much leverage, now all of a sudden you could see this, they have forced selling in order to rectify the situation. That could cause some serious dislocations. So it's been interesting that for 30 years, Japan's been trying to get out of this funk, and now they're starting to, and it might end up causing a serious problem for them. And then the fact that they're a large owner of treasuries, it could end up being a serious problem for us as well. So it's certainly something to watch. It's something that I'm looking for. And this week it was kind of interesting to kind of jump back here to the currency. If you go all the way to the far right, it's hard to see. It says USD JPY 152, but it got up to 160. So it was starting to crash. I mean, the Japanese yen was really shooting straight up. And then you saw kind of a huge move down overnight. So clearly it was some intervention by Japan, but it also what they think is that our Treasury Department kind of let the Japanese government know that there was some bad data coming out on our economic front. It's funny, the past couple of days in the U.S. stock market were very good, but they're only very good because the economic data was very bad as far as jobs numbers. The ISM services was contracting. So we had a really horrible data day. So that gave the Japanese yen a little bit of cover relative to the US dollar in the very short term. But you can clearly see this trend is not working the right way for Japan, and it's something to watch. Okay, so I'm watching this thing closely. It's something that doesn't get a lot of press, but it's something that can have a really big impact on us. Next, I wanted to kind of jump in and talk a little bit about China. Now, as all of you know, we've been outsourcing just a massive amount of our manufacturing and goods to China really since the early 1990s. Almost the same time that Japan started to see their struggle, we started to turn to China to outsource a lot of things. And you know, everybody knows what China's operation is. They bring over U.S. companies, let them manufacture here, and then they essentially steal our technology. They learn what goes into the products, the manufacturing, and then they start to build their own. And then what they do is they start to put restrictions on the U.S. and other countries' manufacturers that are there. So they basically let you in, steal your information, and then box you out of that economy. And the thing is, you still see so many American companies will bend over backwards for the Chinese government because they want access to that 1.3 billion market. Whereas they don't realize that all China is doing is going to steal your technology and then throw your ass out anyway. So it doesn't make a lot of sense to me. But this is a new electric vehicle produced now by China. It's called the Seagull, and they've gotten to the point where it would only cost about $10,000 US dollars. So you can see this is just ridiculously inexpensive. So they've already done about 35,000 of these Seagull models just in March alone of this year. And the parent company is BYD. So, they did 280,000 Seagulls last year inside China. But, now they're at a point where they think they can even get it under $10,000 a year. and these things, while this certainly isn't a missile here, this isn't anything that's going to, be huge as far as power, but they can travel for about 190 miles between charges. So for the vast majority of people, that easily covers your commuting for the day. Some people might be there commuting for the week. Now, originally what happened, as I mentioned, so many U.S. manufacturers ran to China in order to get access to this huge market, these 1.2 billion people that are going to eventually become consumers. And you can kind of see from 2006 up the number of U.S. passenger vehicles and trucks that were exported here from the U.S. to China. And you can see it got to be pretty substantial there for a while. But since 2014, we've definitely seen a pullback. And we're going to continue to see a pullback. So the first thing that they did was they started to put tariffs on our autos. In fact, they went up to a 40% tariff on U.S. autos. So that's the first thing. They start to box you out of the market, make it more expensive to buy the U.S. cars that the Chinese consumers were used to buying. And now they're going to, since they have the technology, they'll blast cheap cars to China that are made in China from Chinese companies. And the thing is, Chinese companies have a 25 to 30% cost advantage over U.S. competitors in the EV field because they've taken over the whole battery supply chain. So many of the batteries that are produced for electric vehicles and just battery technology in general has been outsourced to China. So they have a huge advantage there that they can turn into cost savings to bring down the cost of their vehicles relative to us. because we still have the cost of shipping that stuff back over to us, paying tariffs and going through all that kind of stuff. So what did U.S. do during the Trump administration? Well, we kind of retaliated, and we put a 27.5% tariff on Chinese-built electric vehicles. So if they're going to throw a 40% tariff on our vehicles, we're going to come back and hit them with a higher tariff on our end. Fair is fair. And what it was is right now there's only a 2.5% tariff on imported cars in general. And then we put an extra 25% tariff on the Chinese-made cars. So, of course, China's not happy about that. So now actually somebody's holding them to account for their dirty deeds. But there's an issue. As you know, you probably have at one point heard of NAFTA, the North America Free Trade Agreement. That's basically between the U.S., Canada, and Mexico. And we essentially don't have any tariffs between the three of us, and products can move between our economies really with very little friction. And what we've seen is something very interesting this year, in that for the first time ever, Mexico has passed China as our leading source of imports. So Mexico is the largest importer to the United States now. China is second, and Canada is third. Interesting. So Mexico's economy has just gotten that much better. Is that what we're looking at here? Or is what we're witnessing sort of a backdoor deal from China to get around our tariffs? So China is investing heavily in Mexico. This is a chart just showing you direct investment from China to Mexico going all the way back to 1999. And you can see definitely an upward sloping graph. At one point in 2021, right after COVID, it was a massive investment. They've put in just in the last year 1.1 billion to produce cars in Mexico. This is, I think it's Hofasan. I think that's how they say it. But they just built a 1.1 million square foot factory in order to build automobiles and parts in Mexico. So right now, there are 33 auto part makers registered in the country of Mexico. At this point, 18 of those 33 are now Chinese owned. So China is basically moving over their lock, stock, and barrel. And the thing is, it's an absolute perfect backdoor for China, because any electric vehicles with parts made in Mexico can qualify for that $7,500 electric vehicle credit that we give U.S. consumers. So they know that they've got something here. They've openly admitted that they understand that they can get around that 25% tariff by coming over here to Mexico and investing there. And the crazy thing is, it actually makes economic sense for China, because we're at a point now where the labor in Mexico is actually lower than the cost in China. The average hourly rate right now for a manufacturing worker in China is $4.50. But for a Mexican manufacturing worker, it's only $3.95. So not only are they getting a backdoor to our markets, but they're also going to possibly save money on labor by doing this. And the thing is, while we may be able to set some tariffs, and probably some of the other Western countries in the world will set tariffs to protect their auto manufacturers, the reality is the rest of the world really doesn't care, and they will take these cheap Chinese vehicles. Right now, just in Latin America last year, 20% of the light vehicles sold in Latin America were imported from China. So if you're an up-and-coming economy in Latin America, in India, in other parts of maybe Southeast Asia, you don't care that it's China. You want the lowest cost product you can get. And you don't really have a major auto manufacturer to protect within your boundaries. But just think for a second, what's this going to do to the U.S. manufacturers if all of a sudden we're flooded with $10,000 EVs? How are we going to compete? We've already lost access to the Chinese market. You see the deals the UAW has made recently with U.S.-based manufacturers. How are they going to be able to continue to pay those rates if somehow China is able to completely invade our country or flood our country with cheap cars? But the thing is, it's not going to stop with auto manufacturing, just as it didn't stop with solar. Essentially everything we've outsourced to them manufacturing wise, they have taken that over, but they definitely want chips, microchips. And so far they haven't had success on that. Of course, as you may know, that Taiwan is the largest producer of chips in the world. And, China has been saber rattling for a while on that. And we have so far protected it. But don't think for a second that they're not already moving full board to try to figure this out. And what China first has done is they have raided some Taiwanese companies that produce chips. They're going after employees to bring them over to the mainland China in order to help them start to build their infrastructure for microchips, semiconductors. So they're already kind of doing it through nefarious means, which should be no surprise to anyone. And it's already starting to hit. We still thought that they're so far behind on their chip production and abilities, but then their mobile phone company, Huawei, I can't pronounce that, but if you look at what they're doing, their processors, it's really they're getting much faster in their efficiencies and abilities with their chips. And it kind of blew away the Pentagon in Washington, D.C., of what they could do. They came out with a 7 nanometer semiconductor chip, which they thought no way could China do this. And they're already there. So, of course, semiconductors are absolutely key to everything. Our U.S. defense systems, basically every product that we produce, that's been our one last huge advantage relative to China, has been our chip manufacturing. And as you might recall, one of the times I was actually for government spending on, basically subsidies for the companies was we're trying to bring it back here within the boundaries of the United States with the CHIPS Act. We're trying to get manufacturing of chips here so we aren't as dependent on Taiwan in case things don't go the way we want it to there. But the problem is now the fact that we're pulling in some of this manufacturing and capacity, but we don't necessarily have the workers here in the United States. Our education systems become such trash, honestly. I mean, it's the point where when you look at the amount of STEM graduates we're producing through the colleges, as opposed to all these silly, stupid majors, all the art histories and women's studies and all that stuff will do nothing for us, and really probably for the person who comes out with $200,000 of student loan and they have an education that's worthless. I should say worthless, but is not going to produce an income. That's an issue here. And you can kind of look at these stats, but, essentially, we're going to be short having people that are able to do this. We have to not only try to bring these jobs back in, but we need to restructure our education system in order to provide people with the ability to do the necessary manufacturing work in the semiconductor field. So It's just one of those, if you know kids going to school, tell them, hey, if you get into engineering, and it's hard engineering. It's, if you're actually doing the engineering work, it's electrical engineering, and that's hard work. But even on the manufacturing side, it's going to take, it doesn't necessarily have to be a 4-year degree in the manufacturing side, but it does take a lot of specialized training. But we have to start to think, how do we build the education program for that? And it would be a fantastic career for somebody who does this. They're starting to work with some of the junior colleges, community colleges to get the programs in place, but we're not there yet, and we need to get there quickly. Okay, so I just thought I'd go through a few of those. So the last thing I was going to talk about real quick is a lot of people, the next question might be is, well, should we invest more in China? Is that a good place to go as far as investment dollars? Now, to that, I'd probably say, no, it's not. And one of the biggest reasons is if China is going to basically backstab the U.S. economy through nefarious means, don't you think they would do that to the investors? And in fact, they've already done that. Probably 2 or 3 years ago, I interviewed a guy I knew in high school, and he was in a movie called The China Hustle. And I'll show you a quick demo for that, and then we'll talk about it. So this was the official trailer for The China Hustle.
What is capitalism? It rewards those who work hard, but it also rewards those who take advantage of others.
After the mortgage crisis in 2008,
everybody's looking to get their money back. China's this exploding market.
It blew my mind.
Let's invest in it now.
Everybody thought, I want to be a part of the China growth story.
We're making a profit. $22 million, $100 million,
$20 billion.
$50 billion. This was simply too good to be true.
And it was.
There are no good guys in this story, including me.
Over 300 businesses operating in China, listed here in the United States.
Public traded stock. It was legit.
But I believed they're misrepresenting and doing less business than they had claimed. So we went to China to monitor one of these companies.
Roads in poor shape.
Garbage, rotting.
A busload of investors shows up. All of a sudden, things get turned on. They leave. All the lights go back off.
It's a $150 million company.
It's a total fraud.
If this one company is so brazenly fraudulent,
we have to worry about all of them here in the United States.
this is the largest financial crime of the last 25 years.
We've never seen a credit buildup that hasn't been followed by a major financial crisis.
Hold on to your wallet.
The government knows what's happening.
That money belongs to mom and pop investors.
The reality is they're going to do nothing about it.
The bad guys in finance are attracted to greed.
I didn't do anything wrong, so I want out of this.
You can't even find people that will help us.
The best place to be a criminal is someplace with no cops.
This is a perfect storm.
Hundreds of billions of dollars that just poof, vanish. It's everybody. It's every bank.
Stay tuned.
The China Hustle.
There's an old joke that the biggest lie on Wall Street is that this time it's different.
In theaters on demand, iTunes, and Amazon Video, March 30th.
So I talked to, his name's Dan David, talked to him a couple of years ago. We went to high school together. You never would have thought he'd be a hedge fund manager back then. And he readily admitted, you know, he kind of majored in football. But this was really after the 2008 crisis where, like they said, is Chinese companies were taking over listings on the U.S. stock exchanges. They were taking these ticker symbols over that were either defunct And then they were producing clearly fraudulent information. They were saying their sales are up 80%. They produce X amount of goods, but they weren't. They weren't abiding in any way by our regulations of data, anything like that. They were just lying. And the Chinese government wasn't going to do anything about it. They were not going to prosecute Chinese people for misdeeds in the United States. So I'm still very skeptical of China as an investment. And I still think they have some struggles ahead of them dealing with the debt that they've taken on. So I don't think it's a place you really want to go to as far as an investment, because you're not only going to just have issues with the debt and everything that they're doing, but they're going to outright just lie to you. So yeah, that's basically what I've got. I just thought that would be interesting, something kind of get some information out to you on that. The biggest thing I'm really watching on this is what's going on with Japan. I think it's a bigger issue than what people are talking about. And if they start to have a real currency crisis, that's going to come back here, because their only way to fix it is to dump treasuries. And if they do that, we're at 4.6% in the US 10-year treasury, which is sort of the bellwether for everything, mortgages, credit card rates, everything like that. If that got up to 5-6%, you're really going to see some dislocations here in the US. And you're going to put the U.S. government in an even worse position, as we already talked about. We've got our interest on the debt is a bigger expense than our military. So it's a real situation we need to watch here. So I don't see any questions. So yeah, I guess I'll let you all go, and I hope you have a great weekend. And we'll talk to you here in a couple weeks. Take care, everybody.